Welcome back to Trading Titan TV. Today we delve into the intricate world of candlestick patterns. As we venture into this fascinating territory, let's start at the beginning. Candlestick patterns are a form of technical analysis, and they originated in Japan over 300 years ago. Yes, you heard it right, 3 centuries. They were first used by rice traders who found that these patterns could help predict future price movements. Now you might be wondering, what's the big deal about these patterns? Well, candlestick patterns are more than just lines on a chart. They're like the footprints of market sentiment, revealing the tug-of-war between buyers and sellers. By learning to read these patterns, you can gain insight into the market's mind, so to speak. Imagine being able to predict the market's next move before it happens. That's the power of candlestick patterns. They can provide you with an edge in the market, helping you anticipate potential reversals and continuations in price trends. This can greatly enhance your trading strategy, whether you're a day trader, swing trader, or long-term investor. But let's not get too ahead of ourselves. Mastering candlestick patterns is no small feat. It's akin to learning a new language, but instead of words and grammar, you're dealing with shapes and patterns. And just like any language, it takes time and practice to become fluent. So are you ready to embark on this journey? Are you ready to learn the language of the market? If so, stay tuned as we dive deeper into the anatomy of a candlestick, explore basic and advanced patterns, and see how these patterns apply in real-world trading scenarios. Remember, the market is a complex beast, full of twists and turns. But with the right tools, like candlestick patterns, you can learn to navigate its unpredictable terrain, making more informed trading decisions along the way. Before we dive into patterns, let's unravel the anatomy of a single candlestick. At first glance, a candlestick might look like an abstract piece of art. But once you break it down, it's a treasure trove of information for traders. Imagine a candlestick as a visual summary of a specific trading period. It's made up of 2 main parts, the body and the wicks, also known as shadows. The body, the thicker part of the candlestick, represents the opening and closing prices during the trading period. If the body is filled or colored, it's a signal that the stock closed lower than it opened. On the other hand, if the body is empty or a different color, it suggests that the stock closed higher than it opened. The wicks, those slim lines poking out from the body, represent the highest and lowest prices during the trading period. A long upper wick indicates that buyers attempted to push the price up, but sellers fought back and brought the price down. Conversely, a long lower wick suggests that sellers tried to push the price down, but buyers resisted and propelled the price up. Now, let's talk about the size and color of the candlestick. A large body signifies strong buying or selling activity. A small body, however, indicates little price movement and could suggest indecision or consolidation in the market. The color of the candlestick is also significant. Traditionally, a black or red candlestick signals a bearish market sentiment, while a white or green candlestick indicates a bullish market sentiment. In essence, each candlestick provides a snapshot of the tug-of-war between buyers and sellers. It reveals who's winning the battle and gives us clues about potential shifts in power. Reading candlesticks is like reading a book. Each one is a chapter, and together they tell the story of the market. Each candlestick tells a story of market sentiment, and together they weave the narrative of market trends. Now that we understand a single candlestick, it's time to explore some basic patterns. Let's start with the doji. Doji is a Japanese term that translates to "at the same time." This pattern occurs when the opening and closing prices for a period are virtually the same. The doji is a sign of indecision in the market, where neither the buyers nor the sellers are in control. This could be a precursor to a potential market reversal, making it a pattern worth watching. Now let's move on to the hammer. This pattern, shaped like a hammer, is formed when the market opens, experiences a significant decline, but then rallies to close near the opening price. The hammer signals a potential bullish reversal after a downtrend, acting as a beacon of hope for buyers. Next, we have the engulfing pattern, which comes in 2 variants, bullish and bearish. The bullish engulfing pattern occurs when a small bearish candle is followed by a larger bullish candle that completely engulfs the previous candle. This pattern often indicates a potential bullish reversal. On the flip side, the bearish engulfing pattern is formed when a small bullish candle is followed by a larger bearish candle. This pattern indicates a potential bearish reversal. But remember, these patterns alone should not dictate your trading decisions. They should be used in conjunction with other indicators and market analysis tools to increase the accuracy of your predictions. Also, it's crucial to note that these patterns may not always result in the expected market movement. They merely indicate potential possibilities. The market, after all, is influenced by a myriad of factors and can sometimes be unpredictable. These basic patterns are the building blocks to more complex candlestick formations. They help us in reading the mind of the market, and with practice, you'll be spotting these patterns in no time, enhancing your trading prowess. Ready to level up? Let's dive into some advanced candlestick patterns. Our journey continues as we delve deeper into the world of candlestick patterns, where the narrative of the market unfolds. The patterns we're going to explore now are more complex, yet they offer a richer understanding of market sentiment and potential price movements. First on our list is the morning star. This is a bullish pattern that appears after a downward trend. It consists of 3 candlesticks, a long red, a short one of any color, and a long green. The morning star pattern tells us that the bears are losing their grip and the bulls are ready to take over. It's like the first light of dawn after a dark night, signaling a new day and a new trend. Next we have the evening star, the polar opposite of the morning star. This bearish pattern emerges after an upward trend and signals a potential reversal. The evening star consists of a long green candlestick, followed by a short one of any color, and then a long red one. It's like a sudden burst of twilight after a sunny day, indicating that the bears are ready to take control. Last but not least, let's look at the 3 black crows. This is a bearish pattern that consists of 3 consecutive long red candlesticks. It signifies that the bears are in full control and a strong downtrend is underway. Picture 3 black crows cawing ominously from a tree, forecasting a storm on the horizon. Understanding these advanced patterns is like learning a new language. At first, it might seem challenging, but with practice, you'll start to see the patterns clearly, almost as if they're speaking to you. Each candlestick pattern tells a story about the battle between the bulls and the bears, the ebb and flow of the market. By mastering these advanced patterns, you can gain a deeper insight into market psychology and anticipate potential price movements. This in turn can significantly enhance your market analysis and trading strategy. Mastering these advanced patterns can significantly enhance your market analysis and trading strategy. So, how do we apply these candlestick patterns in real trading scenarios? Well, let's dive right into it. Think of candlestick patterns as your secret decoder ring, a tool that helps you decipher the complex language of the market. But remember, they're just one piece of the puzzle. For the most accurate read on market sentiment, it's essential to combine candlesticks with other technical analysis tools. This could include trend lines, support and resistance levels, moving averages, or even volume data. Here's why. Let's say you spot a bullish candlestick pattern. This signals that buyers are gaining the upper hand. But if this pattern appears near a strong resistance level, it could mean that the bullish momentum may soon run out of steam. This is where combining candlestick patterns with other tools can give you a more comprehensive view of the market. Now let's quickly recap what we've learned today. We started with an introduction to candlestick patterns, exploring their origins and significance. We then delved into the anatomy of a candlestick, dissecting its body and shadows to understand what each part signifies. Next, we moved on to basic candlestick patterns, such as the doji and hammer, and how they can signal potential market reversals. We then ventured into the realm of advanced patterns, like the morning star and evening star, which offer deeper insights into market sentiment. Today's journey through candlestick patterns has been enlightening, hasn't it? But remember, the real learning begins when you start applying these patterns in your trading. Practice makes perfect, so don't shy away from analyzing different charts and identifying various patterns. Remember, the power of candlestick patterns lies in their ability to provide a visual representation of market sentiment. Keep practicing, and soon you'll be reading the market like an open book. Thank you for tuning into Trading Titan TV. Stay sharp and trade smart.